Alright, what's up guys? Scott here again with a brand new video, and in this one, I'll be showing you guys the three major different types of stocks that, in my view, you should avoid trading altogether, specifically for options selling strategies. So that includes things like your credit spreads or your iron condors, strangles, things like that. Although that being said, a few of the things I'll mention in this video are still applicable to options traders in general. So option buyers, option sellers, everybody inclusive. So bottom line here, after watching this video, definitely do yourself a favor and avoid trading these stocks going forward, and you will likely save yourself a lot of pain and a lot of money. Now briefly here before we get started though, if you guys want to learn how you can automate your specific option trading strategy and perform detailed trading research with things like backtesting software and trading simulations, then make sure you watch until the end of the video. And also here, if you want to join a very exclusive online community where you can learn how to trade options and my overall custom approach to the markets, then you can now join my options trading Discord as well. So definitely check out the video description below to learn a lot more about that. And then lastly here, for anybody who is also brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out. And when you join Skillshare using those links, you'll get a full 1 month free trial. All right, guys, so now diving in here, and the first major stock that you should avoid, and this one is applicable to all options traders, both buyers and sellers inclusive, is you want to avoid stocks with very illiquid option markets. Now, what does this mean exactly? Well, to give you an example, let's take a look at a stock called KLAC. So specifically, this is KLA Corporation. But now if we go to the trade tab for the stock and take a look at the option chain here, and for example, we'll go into the typically most liquid expiration, which is the nearest expiring monthly contracts, in this case, September 16th. So we'll unfold this tab here and then scroll down a little bit. And so generally speaking, the liquidity of any kind of asset, stock, options, futures, crypto, etc., simply refers to how actively traded that particular asset is. Right, so basically if the markets for that particular asset are very active and there's just tons and tons of people wanting to trade it, then you would describe that as having very, very good liquidity. And then conversely, of course, if there's just no one in sight, no interest in trading that asset, that's very bad liquidity. And so now when it comes to assessing the liquidity for an options market, the best two metrics to look at are the volume and the open interest. And specifically, the volume here corresponds to how many of these individual contracts were traded in today's trading day. And so as you can see here for the call options on KLAC, almost no contracts are even traded at all today. Right, the volume for most of these options is 0, and looks like the most heavily traded contract is this one right here, the 385 strike call, and only 10 contracts have been bought or sold today. And then for the open interest, as the name kind of suggests here, this refers to how many contracts are still open, or basically have yet to be settled or closed out. And again, as you can see here for the call options on this stock, the open interest is very, very low. Right, so as you can see here, the open interest for the majority of these contracts is just a few dozen here at most. And you'll find the exact same thing over here with the put options, almost no volume and almost no open interest. So again here, this is a perfect example of a very illiquid option market. There's just very, very few people here wanting to trade contracts on this particular stock. And there's two major implications of that fact. Number one here, if you wanted to trade options on KLAC here, it's going to be very difficult to find somebody to take the other side of your trade. And that's just, again, because of the fact there's so few people trading these options. And so as a result, any buy order or sell order that you make might just be sitting out there for quite some time until perhaps someone comes along and eventually takes the other side of your trade. But then also the second most important implication of a very illiquid option market is the fact that the slippage costs on your trades is going to be very, very high, which means if your orders do get filled, they're not going to get filled at good prices. So just to get specific here, let's focus on this contract right here, the 360 strike. The bid price is 470 and the asking price is 580. Although of course these numbers are going to change a little bit here. But still the difference between the bid and ask is basically $100 or $1 on a per share basis. So this here is a very, very wide bid ask spread. Now typically the way you assess the fair price for any asset is you go right in between the bid and the ask. In which case here, the fair price for this contract would be about $5.30 on a per share basis. But that being said, you can definitely try to place an order at that exact price, but chances are you will not get filled at that price. Number one, because almost nobody is even trading these contracts. And number two, if somebody is willing to take the other side of your trade, then chances are their price is not going to meet you right in the middle. Right? So for example, if you wanted to buy this contract and you wanted to initially try and buy it at $5.30 right in the middle, but if the asking price is $5.80, which is technically the lowest price somebody in the market right now is willing to sell this contract for, then of course, like I said, chances are you will likely have to increase your price to get much closer to the asking price here. And then conversely, after you bought the contract, if you then wanted to sell it, well, once again, you're going to have to sell your contract at a pretty unfavorable price for you, which means you'll have to come down to the bid price or very close to that. So ultimately here, if you're trading very illiquid contracts, then you'll have to always be paying too much to buy the contracts and you'll receive too little when you sell the contracts. And so that difference in those bad prices is the slippage cost, right? So basically every time you make a trade with these kinds of contracts, you're going to be losing money simply from the transactions of those trades themselves. And so that's why, bottom line, both for option buyers and option sellers, you should just avoid trading these kinds of options altogether. So ideally what you want to see for a liquid option market is the volume in the hundreds, at least for the roughly at the money option contracts. And you want the bid ask prices to be only a few pennies wide. So lastly here, just to give you an example of that, we'll go to AMD real quick. And so here we go. This is the exact same expiration as for KLAC. But for this stock, as you can see, the volume is super high for pretty much all these contracts, especially the ones that are near at the money. Same thing for the open interest. Everything is pretty much in the hundreds or the thousands. And of course, as a result, the bid-ask spreads here are very tight, typically only 2 or 3 cents wide. So again, bottom line here, these are the kinds of option markets you want to be involved in for any kind of option trading. And so now the second major type of stock you should avoid trading, specifically for option sellers now, is any stock where the implied volatility is much lower than usual for that particular stock. So for example, let's take a look at JD, which is JD.com. Basically, it's an online e-commerce company based in China. And then down below, this is a chart showing the implied volatility for this stock over the past 1 year. Now, real quick here, in case you're not familiar with the concept of implied volatility, it basically just allows you to measure the fear or uncertainty about a particular stock's future. And most importantly, the implied volatility for a particular stock is used in part to price option contracts. And specifically, as you can see here, as implied volatility expands or as there's more and more uncertainty about the stock's future, then the option prices for JD.com will also increase. And then conversely, as implied volatility goes back down, then so will the option prices as well. Now also, one of the most important characteristics to understand about implied volatility is that it's mean reverting. And this means that implied volatility likes to fluctuate around a longer term average, right? So whenever it gets too high, it always comes back down. And whenever it gets too low, it always comes back up. And so in the case of JD here, we can say that the average implied volatility for the stock is probably somewhere around this level or so, somewhere around 60%, I would say. And right now, as you can see, the implied volatility is pretty low at only 52%. So again, this means right now the option prices for JD are pretty cheap, and therefore the options are not worth selling anyways, right? Because the premium collected when you do sell them is going to be so small. And then also, there's a pretty good chance at some point in the future, we're going to see an expansion of the implied volatility once again. So bottom line, what this all means is if I were to sell options on JD right now, perhaps a credit spread or a strangle of some sort, and then the implied volatility began to expand significantly for the stock, well, that's going to cause the prices of my contracts to rapidly increase in price as well. And that's the exact opposite thing I want to have happen when I sell options. Right? Because whenever you use an option selling strategy, you want the prices of your options to fall in value. That's how you make money. So, of course, as I said, if the exact opposite happens, if the prices increase, you're going to lose money. So again, that's why when I see stocks like this, where the implied volatility is much, much lower than usual, I will avoid trading it altogether for option selling strategies. And also, if you use thinkorswim or perhaps Tastyworks as well, you can add these IV rank and IV percentile metrics too, which help you quantify exactly how high or low the current implied volatility is right now. Right, so both of these indicators here are always a number between 0 and 100, and the closer they are to 0, that means the current implied volatility, which right now at 52%, is much, much lower than usual. And then conversely, if the IV rank or IV percentile is close to 100, then that means the current implied volatility is much higher than usual. Right, so these points, for example, would be areas where the IV rank and IV percentile would definitely be around 100. In which case, these would be great opportunities to sell options on JD. But again, for right now, with the IV just being so low, then I would definitely avoid selling options on JD altogether. And then finally here, the third major type of stock I would avoid as an option seller is any stock where the expiration date you want to choose for your trade conflicts with the earnings announcement for that particular company. And there are two main reasons why you should avoid those kinds of stocks as well. And to give you an example of that, let's come over here and take a look at DocuSign. So this stock here is announcing earnings very soon, because if we go to the Analyze tab real quick and then go to the Earnings sub-tab here and we look up DocuSign, you can see right there earnings are scheduled for September 8th, which at the time I'm recording this video is only about 1 week away or so. So therefore, if I wanted to sell options on this particular stock and choose maybe the September 16th monthly expiration, well, obviously this expiration date conflicts with the earnings announcement. And that's a bit of a shame, because as you can see here on the charts, the implied volatility for this stock is very, very high right now, and therefore prime for option selling opportunities. But this here is actually one of the main reasons why I think you should avoid selling options on stocks with earnings very soon, unless you are specifically waiting to sell options around that exact event. And that's because number one here, if you are not trying to trade the actual earnings announcement, then as you will often find with earnings announcements, these stocks tend to move by a very, very large amount. Right? So for example, if let's say you were bullish on the stock and so therefore you sold a put credit spread, and then a few days go by and now the earnings announcement has arrived, but the stock has fallen right down to your short put strike. Well, if the stock has bad earnings and then the stock just plummets, that's going to blow up your entire trade. Now, of course, also there is the chance where the earnings could be fantastic and the stock could skyrocket, and therefore your put credit spread would profit nicely, but it's basically a 50-50 chance as to what the stock is going to do. Right? So bottom line, if you don't want to run the risk of your trade basically being in a very precarious state right before the earnings announcement, and then possibly having the stock just move against you in a huge way and blowing up your trade, then again, that's the first major reason to avoid stocks with earnings very soon. And then the second reason, as I kind of mentioned earlier, has to do with the expanding implied volatility. Right, so back to our chart here, as you can see with these small dots, each one of these represents an earnings announcement for DocuSign. And as you can see down here with the implied volatility chart, every time we get close to an earnings announcement, the implied volatility steadily expands for this particular stock. Right, so you can see this happening every single time. So ultimately, if you sell options pretty close to an earnings announcement, you will likely see an expansion of the implied volatility leading into that event. And as I explained earlier, that's going to cause the prices of your options to increase. And therefore, as an option seller, you're going to lose money. Or at the very least, the time decay on your options might be enough to offset the expansion of implied volatility. But this means the value of your position is just going to remain basically unchanged. And now you still run the risk of the stock moving by a huge amount and perhaps blowing up your trade when that earnings announcement finally does happen. Now, that being said, though, as you can see, after each earnings announcement, the implied volatility comes back down. And so that's why if you do want to sell options around the exact earnings announcement, basically on the day of, that can be a good idea because you are pretty much guaranteed to see a large crush of the implied volatility afterwards. And as long as the stock does not move by too much, you will definitely make money on that kind of trade. So again here, bottom line, unless you want to specifically play the earnings announcement and make that trade right before the actual event occurs, then in my view, it's best to avoid selling options on stocks that have earnings very soon. right? Because otherwise that likely imply volatility expansion going into that announcement. And then also if your trade is just not in a good situation right before the event, those things are going to cause you a lot of pain in the long run. And so with that being said here, that's going to do it for this video. But of course, one last thing, as I mentioned at the beginning, if you want to learn how you can automate your exact trading strategy and perform detailed trading research with things like backtesting software and simulations, then join Option Alpha today for a free 30-day trial. And so this powerful and very easy to use software allows you to rapidly configure trading bots that will execute your exact trading strategy automatically. Right? So it's the perfect way to eliminate human error and emotion from your trading while also ensuring that your portfolio is always being actively monitored and managed while the market is open. And you can also use Option Alpha's powerful backtesting software to improve your strategy by continuously testing and refining your approach over decades of stock market data. And finally, the Option Alpha platform offers a huge online community where you can engage in discussions with other traders, get answers to all of your questions, and find inspiration for new trades and strategies. And so if that sounds good to you, then again, use my link in the video description to sign up and begin your free 30-day trial. And also don't forget to check out and join my options trading Discord as well as my Skillshare courses. Links also in the video description. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.